Again, my name is Jason Love, and I am the founder and lead trader here at the Oil Trading Group. And what I'm going to talk to you about today is defining your trading edge and your statistical advantage over the market. And specifically, we're going to talk about how we go about that process and how to look at that. So first thing, again, just a quick introduction. As Renee mentioned to you, I am a veteran of the U.S. Navy. You can see there to the left, that was my picture back in 1988 when I graduated from boot camp. I think I was the only guy smiling in those graduation boot camp pictures. That's me about 3 months ago. Time certainly takes a toll on us all, doesn't it? Again, like I said, my name's Jason Love. I'm a veteran of the U.S. Navy. I was the VP of a 300-seat inbound travel call center. I founded the Oil Trading Group back in 2010 after I'd been laid off in this travel call center after 9/11. Began the process of learning how to trade, and then started this group here a few years later in 2010. We do a twice weekly segment on Top Step Trader Squawk Radio. We did one this morning where we're talking about some of the price activity and the volatility that's going on in the marketplace. And I am a single dad to an awesome 17-year-old. That's his picture there. He is quite the accomplished baseball player, and as most parents are, I'm super proud of him. All right, so the journey here for all of us is a familiar one. That's me graduating back in 1987. That was the starting point, and we all go through this kind of maze of process of careers and choices and things that we do that have all brought you here to where we're talking today. This journey has no shortcuts, like it was when I went into the military. The top picture again is me graduating from high school. That is a shot of what it looked like in boot camp, to the graduation picture, to where I spent my time on my duty station ship, which was the USS Paul F. Foster, which was a Spruance class destroyer. Happened to be on the ship that shot the first Tomahawk cruise missile, actually, in Desert Storm 1. So again, what I'm going to show you today is hard, but a lot of things are hard, right? The Marine Corps Crucible, their graduation Marine Corps Crucible is a hard thing. Navy SEALs Hell Week is hard. But so is losing weight, stop smoking, quitting drinking. These are things that are all hard, but so is being overweight and the health ramifications of that, getting cancer from smoking too much, or having liver problems from drinking too much. These are all things that are hard. So if you've got a decision to make, pick your hard. You want to pick the hard that serves you the best, right? That's the hard that you want to pick. If it's all going to be hard, pick the one that is going to give you your best chance to find the success that you're looking for. And that's what we're talking about here today. All right, so as you can see here, there's a theme here today. You can see the submarine in the top right-hand corner. I was in the military, and the trading is very much a war, and make no mistake about it. You are battling against forces that oftentimes have greater resources or greater information or better technology than you have. And so trading is a war, and you need to approach it that way. Of course, Sun Tzu, who wrote the famous book, Art of War, talks about victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. And simply put, what that means here is that traders, a lot of times traders that make mistakes, new traders, they think that they buy a book, they buy a program, they implement that program, and they go out and then try to war before they understand what it takes to win. If you've been trading for a while, you understand that you have to have a plan. You know what you're going to be doing, and you know what the outcome is going to look like before you even get started. And that's what my interpretation of this passage means. So what does that simply mean? That means we need a trading edge. Investopedia.com defines a trading edge as a technique, observation, or approach that creates a cash advantage over other market players. It doesn't have to be elaborate to fulfill its purpose. Anything that adds a few points to the winning side of an equation builds an edge that will last a lifetime. And what I'm going to show you today about our trading edge would last you a lifetime. Also, keep in mind, casinos make large profits because all of their games have a built-in mathematical edge on their side. Over the long term, they will make more money than they lose because of their statistical edge. And that's what you need to have, and that's what we try to provide you with as you're trading. So before we get started here, I've got to go through the standard disclaimer. The CFTC Commission wants you to know that futures and options trading has large potential rewards, but also has large potential risk, and you must be aware of the risks and willing to accept them in order to invest. You should seek appropriate advice from your broker or licensed investment advisor before taking any action. And the Oil Trading Group, or OTG, does not hold itself out as a commodity trading advisor. And given that representation, all material presented here today by us, OTG, should not be considered specific investment advice. And then, of course, hypothetical or simulated performance results have certain limitations, and unlike actual performance results, they may not represent actual trading. You can get the full copy of the government required disclaimer on our website, which is oiltradinggroup.com. All right, so first thing I'm going to start with, if you're a University of Michigan football fan, you're not going to like what I'm about to show you here. About 2 years ago, the University of Michigan football team played their in-state rival, the Michigan State Spartans. And this game was a back and forth battle. And as you can see there in that graphic in the bottom right-hand corner, Michigan was the 12th seeded team and Michigan State was the 7th ranked team in the nation. And so as you can see there, with 1 second left, the Michigan was leading 23-21. Now, if you were a fan of the Michigan State football team and you didn't have a chance to watch this game, but you were going to record it, and let's say that you happened to be out at the store and somebody told you, man, what an amazing game, and Michigan State won, and you found out the score inadvertently before you got to watch it, right? Somebody forgot to tell you, spoiler alert, before you got started, but you found out the score before the game was over. As you went home and you said, I'm still going to watch this game, and you sat down and you watched this battle back and forth, and at the end of the first quarter, Michigan was winning, and at the end of the second quarter, it got a little closer, but Michigan was still winning. And it came all the way down to the last 5 seconds of the game, and right before this play that you see on your screen happened, you would have been disappointed, dejected. You've seen your team losing the entire game. They are going to lose, and you would have been really frustrated and stressed out. In fact, you may not have even watched the game had you not heard the score. But the psychology of a statistical edge lets you know what the end of the game is going to be mathematically before the game actually is over. So as you're sitting down on your couch and you're watching this game, and you know that Michigan State, the team in white there that's celebrating in the end zone, is going to get the winning touchdown on a punt, on a muffed punt, with 1 second left in the ball game, you're not stressed out because you knew at the end that, man, I don't know what's going to happen here, but I know they win. And I know the comeback's going to be really cool, and I'm going to sit and stay all the way to the end. And that's what your statistical edge provides you. A statistical edge in the market gives you the ability to know the outcome before it happens. And remember that quote that I just read to you. Victorious warriors win first and then go to war, while defeated warriors go to war first and then seek to win. And so what you are doing with a statistical edge is you know what the outcome of this scenario is going to be mathematically before you sit down and you begin to trade. That takes a ton of pressure off of you as a day trader. So there are lots of things that affect and influence our decisions and the way that we see the world, but knowing that if you stick to your plan and you have a properly defined statistical edge, and I'm going to show you ours here in just a few minutes, if you know that you have a properly defined statistical edge, you are going to be in a much better place psychologically, and the positive impact of knowing what's going to happen before it happens, right? Knowing the outcome before you actually see it happen will do a lot to help your psychology as you trade, and again, is your statistical edge. All right, so a trading test. I like to do this a lot, and just to kind of get a feel for it here. So again, trade number 1 is either a winner or a loser, and trade number 2 is either a winner or a loser. And you can study these circles, these purple dots, day and night, night and day, and you're not going to know the difference between the loser and the winner before you get into it. And that's just like what a trade is. Regardless of your statistical probabilities, your back testing, your forward testing, all of the information that you have done to this point, statistical probabilities, again, testing, back testing a setup, a strategy, forward testing, etc. The moment that you enter into a trade, it is a 50-50 proposition at that point. You're either going to win or you're not, right? And so as day traders, we don't know the difference between a winning and a losing trade before our price either A, hits our target, or B, hits our stop loss. So Vince Lombardi once said, if you can't accept losing, you can't win. Vince Lombardi might have been a trader, because that's exactly what our trading edge is here. I don't need to have a high win rate in order to be successful. I understand that trading is not about having a high winning percentage, but rather it is about managing your risk and your reward. And here's what, let me show you what I mean. So I pulled these statistics out. These are a few months old here at this point, but if you'll notice here on the left that there is a series of calendar months. Everything in green are winning days, everything in red are losing days. And remember what I told you earlier, that what I'm going to show you today is going to be somewhat difficult, at least initially, to get to. All right, so if you take a look at that trader view screen to the right, these are the statistics from the 1st of August in through right before the holiday break in mid-November. And the couple things that I want you to notice here is we are your total gain and loss, your average is about $148 per day on your total gain and loss. But here's the number that I want you to focus in on right here. Whoops, go back a step. I want you to look here that our winning trade percentage was 33.1%. Okay, so our statistical edge involves getting out of trades, like we said, when they are losing, and staying in to maximize them when they are winning. So during this particular window of time, our average number of winning trades was 33%. We broke even on 15% of our trades, and I lost 52%. If you take a look up here, my largest gain on these trades was $1,820, and my largest loss was $340. So if you take 1820 and you divide that by 340, that is a 5-to-1 risk-reward ratio. Also, if you say what the average winning trade is, which was 384, and the average losing trade was 185, that is a 2.1 risk to reward ratio. So you're beginning to see where my statistical edge lies here, and I will show you how you can develop this into your own. It is cutting the losers short and letting the winners run. And so what you need, what traders have a difficult, especially retail or new traders would have difficulty understanding, is that losing is a part of trading, and that you are going to go through periods, if you are properly managing your risk, where you're getting in and then you're getting out. If it's not working, you're getting out. If it's not working, you're getting out. Once the trade begins to work in your favor, that is when you ride the trade for the maximum amount of profit that you can get. Now, you may say, well, Jason, I'm not sure exactly how to go about getting to these big targets. I don't know exactly how to do that. And I'll show you some of the tools that we use a little bit later to go about doing that. But at the end of the day, the most important thing to understand is that when a trade is working, you try to ride it for your maximum risk reward ratio. And I'm going to show you a couple of scenarios here in just a second. First thing I want to do is I want to talk to you about confirming your trading edge. This is what we call our OTG risk analyzer, and it's this tool here that helps us define our particular edge. So I'm going to run through a couple of scenarios here with you really quickly. So the way that this spreadsheet works, the way that this risk analyzer spreadsheet works, is it provides to you a statistical distribution of your trades based on information that you plug into this spreadsheet. All right, so the first thing I'm going to do is I'm going to talk to you a little bit about a discussion that I have with traders quite a bit, and it revolves around all in and scale out versus all in, all out type trades. All right, so make sure I'm being clear here. What I'm going to do is I'm going to run a scenario with you where I talk to traders who get into their position, then it goes positive a certain number of ticks, and let's say they're trading 2 lots, it goes positive a certain amount of ticks, and they take 1 lot off and they let the other one run. Okay, so that is all in, scale out. All right, so I'm going to talk to you about the traders that I have this discussion with. When I talk to traders and they see me trade in our live day trading chat room, they always ask me, well, why don't you take one off at 10 ticks? You just went to break even, right? You just had a trade that went X number of ticks away from you and then came back and took you out of break even. Why didn't you take one off or take some off to protect and then let that other one run? And so I start to do this discussion and we start to do a little bit of math. And so what I found out over the years of doing this, and I've talked to literally hundreds of traders about these kinds of ideas, what I found out is that on average, and we're going to talk about the CL for just a moment, but you can apply this to whatever market you trade. We're going to talk about the CL for just a moment, crude oil. What I find out is that most traders, when a trade goes 10 ticks positive, they take one off. So if you're a 2-lot trader, you take one off at 10 ticks, and then you let the other one run. And so before we talk about what the other one runs, I always ask, what are your stops? What kind of stops do you have? And so there are some traders that have some pretty tight stops, like 6, 7 ticks, which for me is a little bit tight. And then there are traders that have bigger stops, like 20, 25, and 30 ticks, all right? So, but when you mash them all together, we just went with this average for, you get around 10 ticks, 12 ticks, 15 ticks, but for the sake of math here, we're gonna assume for a moment that your risk on 2 lots is $200. That's 10 ticks per contract times 2 contracts is $200. All right, so you take that first winning trade off at 10 ticks, and then you let the other one run. So when I ask traders, what is the amount of ticks on average that your trade goes when you take one off at 10 ticks and you let the other one run? And after a couple of seconds of, well, you know, most of the time I'm really not sure. And so we sit down with those traders and we go through some of their statistics and their logs. And I've done this, like I said, hundreds of times with traders. And what I found out over the years is that most traders, that second contract on the CL, and again, you can apply this to whatever instrument, goes off at about 6 ticks. All right. So if you trade if your winning trades go 10 ticks on the first contract, that's $100. And your second trade goes off at 6 ticks, right? That is $160 every time you win. And your risk on those trades is $200. And so that's another question that I ask is, do you scale out of your losers? Meaning that if it goes 6 ticks against you, do you take one off? And then when that other one goes 10 ticks, do you take it off? And the answer invariably is no, they take the stop to the full amount. As a side note on that, that is essentially letting your loser run and cutting your winner short. And so if we were sitting down at your local coffee shop and having your favorite coffee, and I said to you, are you going to let your winners run and cut your losers short, or are you going to let your losers run and cut your winners short? Well, instinctually, everybody would say, of course I'm going to let my winners run. But then when I talk to them specifically about their trading, they let that stop go to the full stop while they take one off at X number of ticks like we just described. So if you're winning $160 when you win and you lose $200 when you lose, essentially what's happening is for every dollar you put at risk, you are going to get 80 cents in return. Okay, so let's run that math here through this spreadsheet. So we're just going to assume for a minute that you've got a $15,000 trading account. Your risk per trial is $200. So if you say $200 and you divide that by $15,000, that is a 1.33% risk per trade. Commissions here we have at $5. This will account for commission and slippage. Commissions on futures contracts can be as low as 50 cents per turn. And then that would factor in over the course of 100 trades. That would factor in for some slippage as well as your commission. Okay, so that's the way that this thing is set up. In addition to that, this is a total trials of 100. So this analyzer is going to run through 100 randomly distributed trades based upon the information that you put into this spreadsheet. Okay, so if you said that it's going to be at a 1.33% risk and 100 trials, this spreadsheet's going to spit out what you should expect as results on a $15,000 account size. All right, so we're going to switch over to this tab. And what I'm going to show you here is we're going to go over to this historical trade distribution. Now we're going to say that your win rate is going to be 80 cents, right? 62% of the time, you're going to win 80 cents for every dollar that you risk. 37% of the time, you're going to lose $200. So your win rate 62% and your loss rate is 37%. And because you're doing it this way, you're at +1, you're not going to have a lot of break-even trades, right? You're not going to have a ton of break-even trades here. And so this is going to randomly distribute 100 trades, which for me, by the way, is about a month's worth of trading. I trade about 5 times a day. And so at 100 trades, that's going to be about 1 trading month. If you're a micro scalper and your statistics, you trade 100 times every 2 weeks, then you would have to double this in order to get to your results. And if you're one of those that trades 2 times a day, then this might be 2 months worth of data for you. But anyway, this is going to randomly distribute. Now, again, keep in mind, if you had a 6-month performance rating of 62% winning trades, some of those months were going to be a little higher, and some of those months will be a little lower, but this is what the statistical average is going to be. However, this spreadsheet is going to spit out some randomly distributed numbers. So it may be 67% as a win rate on one of these trials that we run, and in some of these trials it might be in the 50s. And so just keep that in mind as we begin to run this analyzer. So if you click start, you'll see here that the initial equity was $15,000. Your risk per trial is 1.33%. Your winning probability is 62%, and your position size is $200 worth of risk. Okay, so just to keep in mind, that could be 4 lots on 5 ticks on the CL. That could be 1 lot at 4 points on the ES, and you could pick out your instrument to get to $200 worth of risk. All right, so we're going to click Run All Trials, and this will spit out an answer here. So your equity, you lost $105 with a win ratio of 57%. So you won 57% of the time, but you lost $100, or your projected loss total would be $100 because your risk reward is a little bit out of whack. But the thing that's probably most troublesome here is if you look at the max drawdown on a $15,000 trading account, you would have your max drawdown during the month would have been $2,100, or 14% of your account. Now, if you're like most traders, you're probably freaked out by that, right? I would probably be a little bit concerned with the max drawdown of 14% on something like that. But what this thing's doing is it's then going to go through and show you what each individual trade would have done. So your first trade here was a winner of $155, right? And then you get to see your return, your position size, the equity return, and your risk multiple. The next trade you lost was $207, right? Because what it's saying is that as your equity increases, so does your percentage of risk, right? So if you're 1.33% initially, right, and you win your first trade, that's going to go up here, and that's what this is doing. This is kind of adjusting. But here's the piece to this, right? You start going through some pretty hairy areas here, right? And that happens. So if your risk reward is out of whack here, and you only win 57% of the time, you can expect a 14% drawdown and a loss on your account of $105, even with a win rate of 55%. All right, let's reset this. Let's start it and let's run it again. All right, so this time you had a win ratio of 60% and you won $1,500. That's a little better, right? With $200 in risk and you won $1,500, that's a little bit better rate of return this time, but you still had to be at 60%, right? Your max drawdown this time was 8.5%. All right, so you get the idea of what this spreadsheet is designed to do, right? All right, so now I'm going to move over here and I'm going to put a link to this study into the chat room here. So I'm going to put a link into the main window so you can take a look at this at your leisure here. And you could got to go through that. So there's a link to this particular Google Sheet study. And so what I did here is I had testing parameters that I said all scenarios were used running that OTG risk analyzer. I assumed that you're trading 2 lots with $200 worth of risk. The initial win rate used here, like we just showed you, was 62%. The risk reward used here was a 0.8 or 80 cents for every $1 at risk. And the win rate assumes the first contract was off at 10 ticks and the second average was off at 6 ticks. And you can play with this in your particular instrument that you like to use. And so I'm going to show you what the final numbers look like here. But the first thing I want to do is I want to show you what a month-to-month comparison looks like here. So this is all of that information randomly distributed out over the course of the first 100 trades. Your equity would have grown from 15,000 to 17,275, and then it's plotted out over here. I plotted it out over here on a graph for you so that you could show your beginning equity, and then that the grayish colored line would be a 10-day average. And so you can see how your equity kind of goes up and down over the course of that rolling 10-day average. So I did this particular setup or this particular scenario for 6 months. Month number 2, you started out with 17. You started out up here with 17.2, And by the time you got down to the end of this month, you finished up at 17.1. And you could see here how you were really took this steep angle drawdown where you were clearly below your 10-day average. In fact, you lost at one point, you lost all the way down below 15,500. So you were almost back to the start of this particular run, despite the fact that in month number 2, you had a win rate of 57%, right? So basically, you can go through and kind of look through all of these different months here, but here's how you would have finished up with a 62% win rate on $200 of risk on a $15,000 trading account. Not bad. You end up with $18,551. That's a $3,500 gain over the course of 6 months. Your max drawdown at any one point during a month was 14%. You had a 12%, you had an 8.5%, and you had a 9.5% drawdown. So these are pretty steep drawdowns, right? But it is because your risk reward is not greater than 1-to-1. It's at a 0.8 to 1 risk reward ratio. All right, so I'm going to run. I ran the same exact scenario, or sorry, I ran another 6-month window here, and I'm going to go here. This is the all-in, all-out approach. All scenarios were run using the OTG risk analyzer. The initial win rate for the algorithm this time was 31%. So remember, I showed you just a few minutes ago that during that 6-month window or 4-month window towards the end of the year, 4 or 5-month window, my win rate was 33%. So I'm saying this time the win rate's going to be 31%, but this time the risk reward that you're going to be looking for is 2.5 to 1 on your risk reward. So I'm reducing the amount of risk on the front end and maximizing the amount of return on the back end, right? So if you recall on those statistics that I showed you just a few minutes ago, I was at 2.1 to risk reward. This time I ran these at 2.5 to 1, which means for every dollar at risk, you're going to have a $2.5 return. All right, so I ran those same statistics. Okay, I ran those same statistics here, and this is what you ended up with at the end of the same 6-month window. Your equity was on a steady march to the top side, right? Your max drawdown here at any one month was 6.7%. That's about half of the largest drawdown. It's about average of what the 2-lot drawdown was. The other thing to consider here is that if you're risking $100 per trade on a $15,000 account, you're only risking 0.66% of your account, which means that you could trade longer, you can withstand the ebbs and flows in a better way. But here's what I was talking to you about. I want to show you a couple of these things here. Here's why I said this is hard, okay? Look at this run right here. You see that run right there? That is trade number 5 to trade number 34, okay? So trade number 5 to trade number 34 is about 30 trades, right? Your break even or losing on all but 1, 2, 3, 4, 5, 6, 7 of those trades. 7 divided by 30 is 23%. That's a 23% win rate during that run, okay? That's a 23% win rate during that run. What does that tell you? Well, most traders, when they go through a run like that, begin to do something. They do either one of 3 things. They bail on their trading system. They just completely bail on it and they move on to something else. This one's broken. This one doesn't work. It's broken. Or they begin to tweak it, right? They begin to tweak the crud out of it, meaning that I need to, okay, so the system worked pretty good. And let me give you an example. If you went through a run like this, okay, you were in a guy like mine trading room and you said, man, over 2 days, he had 6 trades here and he won 5 of the 6 trades, right? So 5 divided by 6, I won 84% of my trades. You made nearly $1,200 over the course of 2 days, and you buy the trading system, and almost immediately it goes through this run right here, right? This real negative run. Now, keep in mind, this run rate this month was 25%, yet you finished from $15,000, okay, at $15,700, but your win rate was 25%, right? Your win rate was 25%. You go into the next month and you have a win rate of 31%. You went from $15,792 to end that month at 19,137 with a 31% win rate. So you remember back when I told you that this was going to be hard, that this is not an easy thing to get your mind wrapped around, that when you get out of trades, when they're not working, when you just get out, you get out, you get out, when those things are occurring, you're going to have a very high percentage of non-winning trades. There's a big chunk here of break-even trades, right? There's a big chunk of these $5. These are all the $5 break-even trades, right? There's a big chunk of those that go on in this particular, in these scenarios. And that's what makes this really difficult, is that knowing that you're not getting paid necessarily on win percentage, you're getting paid on your risk reward ratio, right? And so this is running through this here and will give you a good, you can go back and study just exactly how these things kind of play out. But if you look at it here over the course of month 1 to month 6, there is an equity growth of about $14,000 on one lot with a $100 risk on a $15,000 trading account. Your win rates are 25, 31, 36, 29, 33, and 33. Your best month here, your cumulative here, you ended this month 6 at a $3,500 win versus a $14,000 win with one lot trading 2.5 to 1 risk reward. The closer you can get to 2.5 to 1 risk reward, the much better off you're going to be as a trader, right? It's not about high win percentages. Guys in my business will tell you I've got this win percentage of 70% or 65%, and that's really appealing to people. But the missing component is, what is the risk? What is the drawdown? What are these other parameters, that the components that aren't being mentioned to you? So again, I'm going to go back here and I'm going to show you from August during this 4-month window, that is about on pace, right? We said during this 6 months, there was a $14,000 equity growth in 4 months using a 33% win rate, which is a 2% greater than the 31%. The equity growth here was 10,800, right? That's almost the same identical number as spitting out here at your 6-month rate of return, $100 risk on a $15,000 account. But again, this is hard to do because sitting through a lot of losing and break-even trades can be psychologically difficult. But like the Michigan State football game that I showed you earlier, you recorded the game. You knew what the outcome of the game is going to be before the game was even played. In this case, you knew the outcome of the Michigan State football game before you sat down to watch it. And so your stress levels and the amount of emotion involved is dramatically decreased because you know the outcome. A casino that sees a guy win, you know, $10,000 on the blackjack table is not freaking out because they statistically, they know the outcome either from him later on or the other multitude of players that are sitting at their table. They know the statistical outcome, and that's where an edge is most beneficial to you, right? Is being able to give you the peace of mind to understand how your particular system performs. What I just showed you here is a simple 2.5 to 1 risk reward. This particular tool, you can put in whatever risk reward you want to. You can play around with that to find the sweet spots that make you comfortable, right? You could find those sweet spots that make you comfortable. All right, let's continue to move on. So understanding risk reward really is the holy grail of trading. You have equity growth is a function of your win rate, your position sizing, and your risk to reward. And if there is truly a holy grail in trading, that's what it is. It is understanding that your statistical edge as it relates to your risk reward is what's going to give you the best advantage at the end of the day. All right, so we're going to talk about trading tactics here for just a couple of minutes, and then I'm gonna be winding it up and we can talk about questions. So you say to yourself, okay, that's great and all. I know, Jason, that 2.5 to 1, I mean, what are you telling me? That's something that I know. That if I had a 2.5 to 1 risk reward, what I don't know is how to do that. I don't know how to get to that particular point where I can, you know, get to understanding how to identify a target. So what I'm about to tell you is the tactics that we use. So if you think about it in these terms, we all have the same objective in the world. We all want to be successful traders, right? That's not something that I think any of us would balk at. But the definition of success is going to be unique to the individual. So what that means is that one person might feel like that success is a 5% equity growth a month. Another person who's just starting out may say, gosh, you know what? I'm just tired of losing. I'd like to have a break even or slightly better month. Whatever your definition of success is, it needs to be quantifiable. Okay, so that's kind of the high level, top layer idea. We'll all agree on that. The second layer to this is, how do we get there? What is your statistical edge to help you get there? For me, it is cutting my losers short and letting my winners run. I don't get discouraged by having a low win percentage because I don't get paid on win percentage. You get paid on the amount that you get back from your trades. So if you're at 2, 2.5, 3 to 1 risk reward, right, you know that you don't have to be right. In fact, you are going to be wrong a lot because you're throwing trades back when they're not working. You pull it in. It's like that. It's like those fishing shows you watch on ESPN, maybe on Sunday mornings. You throw your line into the lake. You pull out a fish too small, you throw it back. You pull out another one too small, you throw it back. And then, whoa, you got the big bass that's 9 pounds or whatever, right? I'm not a fisherman, you can probably tell, but you get the idea. Is that when it's not working, you get out, right? And so we would all agree that when you win, you want to win more than when you lose. I don't think anybody in here would disagree with that idea. And so that's the same thing in trading. That's our edge, right? We are going to cut our losers short and let our winners run. What I'm about to show you and tell you is our trading tactics. And this is where we will all deviate. There are as many trading setups, tactics, as there are people in the world doing them, okay? So if there are 10 people in the room looking at the market, we can all look at the same exact chart and see 10 different ideas. Your tactics, your setups are going to speak to you based upon your life experiences and the way that you see the world, right? That's what's going to happen. You're going to have, your tactics are going to be based upon those ideas. So what I'm going to share with you here are basically our tactics. Before we do that, there are 3 basic entry types, as you know. There's the fade trade, the breakout trade, and the reversal trade, right? A fade trade, you fade into a support level. A breakout is a particular level that you're watching on the chart. You look for the breakout above. And a reversal trade is you were looking for it to pull back underneath and then break out above, or you could reverse that and pull up and then come down. If the number one job of a professional trader is to preserve capital, right? Your first job as a trader is not to win money, but your first job as a trader is to preserve your capital. Then the number one purpose of a trade setup is to offer you a stop loss location that limits your trading risk. Your number one job of a setup is not to make money. It's to find a spot on your chart so that if it's not working, you throw it back quickly before it gets out of hand, okay? So that's, having said that, that's our approach to trading tactics. Our trading tactics fit into 3 categories. We give you support resistance decision points. We have a volume and order flow tool that we look at, and then we use price charts and patterns. All right, so the first thing I want to do before we go any further is we've got a YouTube channel. So we don't just talk about trading. We have a trade room that meets every single day. We get started at 7:45 a.m. Central Standard Time. We look at both the ES and the CL to trade every morning. And if you take a look here, I just threw a link into the main chat window. I threw a link to the YouTube channel. We have over 400 plus trading videos on both our YouTube and Vimeo channel, and these are trades that were taken in front of a live audience in our day trading chat room. So there are over 400 of these. You'll have price ladders, you'll have commentary, all of that stuff on our YouTube channel, and you could take a look at your leisure at over 400 plus videos that we have actually taken in front of a live audience in our day trading chat room. All right, so let's continue on here. So if you take a look here, We have what we call market maker levels. These are our decision points. These are dynamic support resistance levels that are based upon previous price and time, and they provide our structure within the structure. Okay, this system was originally designed. I had the good fortune of having a mentor. This that was a floor trader for 30 plus years, and this system was originally designed by this 30-year veteran floor trader to be used in the S&P pits. This system has now been modified for electronic trading, and I use these levels each day, and they are available to be traded on all the major futures markets. All right, so I'm going to show you basically a trade that we took on March 13th. Let's see if I can get this to zoom in here without causing me a problem. All right, so these are these levels in action. Basically, we have this nomenclature that we call kick the signal, pay the target. Once we paid this target up above here, we jumped on board with one lot at this structure signal and wrote it down to the target down below. Right, there is this particular trade. This was one particular trading day. My win percentage on this particular day was 25%, yet we had a $2,400 gain on the CL market and the ES actually on this particular day. We had a really nice couple of trades. You can see those trades in their entirety if you go to the YouTube channel and go to video review on March 13th. You can see the 200 tick CL trade and the 14-point ES trade as they occurred in the trading room. You'll hear me get in, you'll see the price ladder, you'll see me get into the trade. And what I try to do with these, because my average trades here, if you look, my average winning trade was about an hour long, and my losing trades were 7 minutes long. So if you said the average winner was 60 minutes and the average loser was 7 minutes, I'm holding on to my winners about 9 times greater, longer than I'm holding on to my losing trades. I'm getting in. If they don't work, I get out. If they don't work, I get out. And that's why your win percentage here was only 25%, but you have a massive amount of gain here. And this video here was plus 200 ticks on the CL at a 14.1 lot ES trade. And again, I would encourage you to go to the YouTube channel to take a look at those. Now, I don't want to just cherry pick a particular trade. I don't have a ton of time in here today to go through in detail all of these different ideas, but this is one idea with our decision points. I have 400 trading videos on our YouTube channel that you could take a look at these in their entirety. We also use this volume, what we call a volume bar tool. Basically, this is our order flow, our definition of order flow, and reading the order flow. So what happens is these bars get bigger and fatter as volume gets pumped into these bars. And so if you see a big heavy bar that is in relationship to some smaller bars around them, you know that more volume was put into these particular areas, right? And so I run into a lot of traders who are interested in order flow, right? I want to read the tape. I want to be able to do that, but they just can't quite get the hang of the cross, 20 hit the bid, 40 on the ask, and what does that mean, and when does it come back, and where's the real heavy area of liquidity? Well, what these volume bars do is they give you a basic idea of what to expect. And so here's a 5-minute chart on the CL. These two heavy bars here indicated that the sellers were in control, right? You had a nice green bar here. It took some heavy selling to get through it. The bar opens up, comes down. And as the market begins to the buyers begin to take over, you can see that the volume is less and less and less. And then right up here, you get right to the top of this area. They try to get through, the buyers try to get through, and the sellers step in immediately, right? They sell the market down, same kind of idea. You get a little bit of heavier buying pressure, but you come right back up here to where the buyers or the sellers have taken over. You come right up into that area, and then it sells off, right? So the bigger, the heavier the bar, the more likely it is that you're going to have support or resistance in a particular area around where those bars are located. So again, these are our trading tactics. Your trading tactics may be different, but this is the way that we get into trades so that we can have that 2-to-1 risk reward expectation. Just to go back to this chart here one more time, one of the reasons that we can hold on for these bigger targets is because we have identified certain levels on our chart based upon, again, our market maker mentor who gave us these insights into how the market moves, right? And so you have these structured targets up here, right? We came back down into this structure signal, and we knew that we would be, or we were expecting that the market would come all the way down to this structure target. This is 61.60 roughly down to 60.52. That's a 100 tick CL move that if we did not have this idea of this signal to target, then we would not have been able to hold on to it for as long as we did. So again, that's our way of being able to hold on for these bigger targets. There's your volume and order flow idea. And then we're big on price patterns. And for entries and or targets, we like head and shoulders, double tops, double bottoms. We do trend lines, bars close above 50 or 66%, bearish and bullish engulfing candles, candlestick patterns and formation, wedges, et cetera, et cetera. So if you break our tactics down, and your tactics may be different, right? But the way we break our tactics down is we have a series of decision points that were given to us by a market insider. We have that volume tool that I showed you, and then we use some very traditional price pattern ideas to be able to get into or out of trades at a particular time. And again, if a trade stops working or it's not working as quickly as it would like it to, we get out, and that is our statistical edge. So I'm going to put a bow on all of this for you here today. If you look at trading as a battle, okay, you need to know what's going to happen before you enter into that battle. The way that you know what's going to happen is you understand your statistical edge. The statistical edge that I gave you today is that you can have an extremely low win percentage, but if you've got a 2.5 to 1 risk reward, you would have a much better chance than a system that has a 62% win rate. I can win at 31% and beat your 62% because I've got a better win rate or better risk reward ratio. Like that football game, okay, like that football game, I would have been stressed out and nervous had I not known what was going to happen at the end. When trading, I may go through a period of drawdown, and you may want to tweak your system, quit your system, do whatever to your system because you don't know how it's going to end because you didn't have it recorded. But if you know statistically that you're going to have periods of time where it's going to go up and down because you're getting out a lot, and if you understand that and you can hold on through your statistical advantage, if you understand and you've got it mathematically put out there, then it doesn't matter. The casino doesn't care if you have 2 players on a really hot streak today because they know there are going to be 10 more tomorrow that are going to go on a cold streak, and their mathematical statistical advantage is going to weigh out in the end. And then finally, the way that you get into your trades are your tactics, but you need to understand and have a tool to be able to gauge how your system is performing in relative terms to what it's been doing in the long haul, and then you can have a tool to be able to tweak these things for you. So here's what I'm going to do today, and then I'll go into some questions. I'm going to make you an offer here today. We have a live Dave Trading chat room that we meet every single day at 7:45 a.m. Central Standard Time, where we put these exact tools and principles into practice every day. I'm going to give you 5 days in our trading room. I'm also going to give you one of my favorite and most used trade setups. And if you're a regular room member in here today, you know that it's awesome. Trade by itself, if used properly, is way more valuable than what I'm even asking for here today. You've got 5 days of trade plans for the CL and ES, and then I'm going to give you this risk analyzer spreadsheet, all for $47. I just threw a link into the main window here for you. But this spreadsheet here is, if you got nothing else from me, right? If you got nothing else from me, but you got this spreadsheet and I teach you how to use it in a video, if you got nothing else from me, that $47 spreadsheet may be the best thing you've ever bought from a trading perspective, because it's not about showing you a setup or showing you some moving average cross or, you know, some RSI divergence. It's not any of that. It is getting you to dig into your performance, your statistical performance, so that you can understand how to tweak it so that you can get the most risk reward, just like those scenarios that I ran for you. So you have 3 links in here for you today. You have link number 1 is that statistical analysis that I went through. Looks like this, and you could go through and kind of see the 2 different studies that I ran. You've got a link to our YouTube channel, which has about 400 videos, trading videos of us live in the market, right? Of us doing this in front of a live audience every single day. And you're going to have, it's not just me cherry picking trades, it's trades that we actually took in front of a live audience. And then the third is to this offer page. For $47, you're going to get free, you're going to get an extended look at what we do in our day trading chat room. You're going to get 5 days of our trade plan. I'm going to give you one of my favorite trade setups. And then probably the most important thing is I'm going to give you the OTG risk analyzer spreadsheet. And if used properly, it will prevent you from moving from system to system to system, because every trading system out there has a sweet spot. You got to find it. Not every trading system, I shouldn't say that. A lot of trading systems out there have a sweet spot, and you've got to be able to find it. But you need to go back and look at what your performance is right now over the course of, let's say, the last 6 months, and then you can run it through the risk analyzer, and it will spit out for you what different scenarios will mean from a statistical perspective, and so what you can expect your system to do. So just as a recap, I showed you what 6 months here worth of data would do to your equity every single month on a 1 lot. Then I showed you I showed you how that looked over 4 months, and it was almost identical, right? That is your statistical edge. Okay, so that link is in there, $47. If you do end up picking that up, look for an email you'll get an email from me with a link to that page. Bookmark the page, the link that I send you to the page, because that's where your content will be. And if you do that, we'll see you in the trading room on Monday. And so let me get to a couple of questions here. Let's see. Okay, there are not a ton of questions, but let me look here. Couldn't have picked, Greg says, couldn't have picked the Notre Dame USC game where Flutie threw. Yeah, I could have done that. That's true. Hans, Jason, what is the price of your room? Hans, send me an email and I will get you that information. I will get you that information. It's not terrible. It's Jason at Mail OTG. I'm going to throw this in here. I just want to talk to you a little bit, Hans. I know you signed up for a free trial today, and so I just want to talk to you a little bit before we go through that process. Mailotg.com. There is my email address in the chat room. Bill asked, what is the URL name using for your email? It is Jason at Mail OTG. Bill? Jason at Mail OTG. So, having said all of that, I don't see a bunch of other questions coming in. I don't see a bunch of other. Yeah, Bill, thank you for the interest. So again, take a look at that. I know that there will be a video recording of the entire range of speakers here today, and so I will also be looking to send you a copy with some additional links as well. So anyway, that is it for me today. One more question. Thanks, Peter. Thanks, I appreciate that, my friend. Peter said, good presentation today. I appreciate that. Rick, it's Jason at Mail OTG. So if you look inside of the, that main chat window, that's where you'll see Jason at mailotg.com. So OTG stands for Oil Trading Group. Mailotg.com. Jason at mailotg.com.